You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today I've got Andy Constan, who's a former hedge fund CEO. Used to work at Salomon Brothers, Bridgewater, Brevenhauer, all these massive big name shops. So it's awesome to get you on, Andy. Thank you so much for being on the podcast.
A pleasure, Sri.
Awesome. So Andy, could we start off with a bit about your background? So, I briefly introduce, the places where you've worked. So could you just go through your background, how you got into finance and sort of your journey to finding Dam Springs and, and the journey till today?
Sure. So I went to college expecting to go to medical school and studied bioengineering. While I was there, I met my fraternity brothers, and my fraternity brothers were all heading toward Wall Street, working. I was at Penn, so they were either Wharton students or economics students or American history students, and they were all heading to Wall Street. And so I was looking around for jobs and decided medicine wasn't for me. Some of them who were already up on Wall Street said, come up and interview for this role in corporate finance. So I took an interview at Salomon Brothers and luckily got the job and joined in 1986 as a investment banking analyst in the corporate finance department. And quickly fell in love with the problems that and puzzles that one finds in finance. Found the math easy, found the technology easy. Lotus 123 had been invented about the same time I joined, and creating spreadsheets was an essential role for analysts. And though the technology was limited, when I joined, I was the first person in the corporate finance department to have as an analyst, to have a PC with a hard drive. And that hard drive had 10 megs of data, not gigs, megs of data. So it was a very different time, but that advantage of being an engineer, being quantitative, and levering my understanding of math to solve these puzzles was a competitive advantage all along. Then I had a brief assignment when I was at Salomon to work on the Presidential Task Force on Market Mechanisms, which is the Brady Commission, which identified the root causes of the stock market crash in 1987. And so as Salomon's representative, I got to meet a lot of the senior-most people at Salomon and a bunch of other people from around the street. And most of my classmates, after their 2-year analyst program was up, moved off to business school before many returned to Wall Street as MBAs. I decided to take a job in the equity department in convertible bond trading, which I was able to get because of my relationships with the senior equity people from the Brady Commission. And that started my journey in trading anything. After a number of years of success on the convertible desk, I moved to take over the equity derivatives trading desk. And then a couple of years later, the global equity derivatives trading business. And then finally, by the time I left, I was a senior member of the equity management committee and running the global equity derivative sales trading structured product business for what had become a huge company with the many mergers between Smith Barney, Salomon, Citigroup, and other things that we acquired along the way. And in 2003, I started my own hedge fund to do, with some peers from Salomon, to do relative value trading, which went well for 4 or 5 years, but ended when the partnership broke up. And so as the financial crisis started, I was trying to launch a new fund with partners that I was more suitable to move forward with. That really got stopped. There was just no way I was going to raise money. We had seed money, but there was no way I was going to raise significant capital during the financial crisis. And so, I'd been doing quantitative RV relative value trading strategies for most of my career. But obviously 2008 was a major shift where it became obvious to anyone that relative value trading is got a significant macro risk to it, as most of the relative value trading strategies blew up along with the banks and their ability to lever those types of strategies and hold positions like that. And so I really thought about what macro meant and figured, thankfully, I had an opportunity to join Bridgewater, and they, I think, are the best macro thinkers in the game. They're not always right, but their thinking is always, in my view, open-minded and high quality. And so did that for a number of years, and left on great relationships with the people at Bridgewater, and I still respect them greatly, but there was a cultural thing which just wasn't the right thing at the time. Their culture fit in very well with me, but where I was in life, I needed to change. And so I was then moved on to Brevin, which Alan Howard and the team there are also phenomenal macro thinkers. And their strategy is radically different than Bridgewater's. And that gave me an opportunity to see while Bridgewater was a diversified, systematic trading business, Brevin was a concentrated discretionary activity, both trying to make money in macro. And so that was for me, a great experience to see both sides of legendary performers. Right. And that takes me to Damp Spring, which Alan helped me launch, and is still an important client of mine, to advise hedge funds, to help them, consult with them to understand what's going on in the world and to express those views in macro directional trading. About a year ago, I noticed that there was, I had been on Twitter for a number of years, mostly as a consumer of news. And I started making commentary on what was happening in markets with, a few hundred followers, friends and family. And the way it happens is it started getting followed by more people. And, within, I guess it's been about 14 months now, I've gone from 300 followers to 30,000 followers. And that's been a wonderful, wonderful journey. I now have access to people I never thought I could have conversations with, where I can have a conversation daily with fascinating, great thinkers. And that's been a blessing for me. And hopefully I've provided a voice that people can depend on. I prize accountability to what I say and why I say it and how that is expressed in positioning and then subsequently in the performance of those positionings, because it's all linked. And that's attracted a variety of other interests, both institutional, hedge fund, wealthy family offices, and a variety of high net worth brokers who are looking for good ideas, and they've asked me to start a service that can give them the attention that they pay for, and so have launched a subscription service for long-term macro thinking with alpha generation. And that's where I'm at right now. It's been a great journey.
Got it. Yeah, no, when it comes to Twitter, that's the best part about Twitter, right? So you get to interact with, some of the, some extremely smart people, especially when it comes to markets. And, one thing that I really love about, your account is that, or like, your Twitter feed is that when you share your trades, but too, you also remain accountable, because, a lot of people make calls and then if they're wrong, they just delete them and, act like they have a very high win rate. And, you're just not that way. You have a lot of accountability. And so, going back to when you were at Salomon, so what was it like, being in Salomon at the heyday, of Salomon Brothers? And, do you have any funny, interesting, quirky sort of stories from, your days on the trading desk?
So when I joined about a year or two later, Liar's Poker came out, which is Michael Lewis's first book, which depicted the scene in the fixed income area primarily, though he did make some funny comments about the worst place to work at Salomon is the equity sales in Dallas. He really focused on the fixed income area and the mortgage area in particular. And I would say those stories are, by and large, completely true. And the personality, though the actual Liar's Poker turns out not to be true. It wasn't John Goodfriend. It was another guy who challenged John Merriweather to a game of Liar's Poker for whatever the alleged bet was. Anyway, I played Liar's Poker. Everyone played Liar's Poker. It was a regular thing. And the book I sent to all my family and friends because I wanted to have them have a picture of what it was like as a 25-year-old working at Salomon. So that's number one. But gosh, there's so many stories. I guess the one that is most interesting to me was right before the financial crisis, the Treasury bond auction scandal hit, which was the summer of 1991. And it resulted in John Goodfriend, the legendary chairman of the company, and Tom Strauss, the president of the company, and John Merriweather from ultimately a long-term capital to leave the firm. And it was a devastating blow, obviously, to the firm. Its rating got cut from A to triple B minus. Its financings got more expensive, and it was, and those who perpetuated the behavior suffered, and they should have suffered. And yet the entire firm, who had no knowledge of this stuff, suffered as well. And but that was what happened. But prior to that, we had in June of 91 entered into an underwriting agreement with Time Warner at the time, which was, a legendary company with multimedia company, Warner Communications, cable assets, parks, the magazines, which were, real businesses back then. And it was an incredibly important company. And they needed money. They had over-levered when they did the Time Warner deal. We were in the midst of a recession, or the end of a recession, and they needed money. And so we underwrote the biggest rights offering of all time, $2.7 billion, which was that's a big number today, and was an enormous number. And the underwriting worked in which we actually had to be at risk for about 3 weeks. at risk of the 2.5 billion. I had the good fortune of having, helped convince Time Warner to choose us and to have us lead manage, and structured the way, again, I had some influence in how it was structured. And I became responsible for the actual underwriting risk taking that happened during those 3 weeks. So I moved up off of my convertible bond chair up to the chair next to Stanley Shopcorn, who was global head of equities at the time. And, the whole firm, essentially, the whole equity department essentially was laser focused on making sure that underwriting happened well during that period of time. And we were constantly trading the underlying, the rights, everything else. And why I mention that is because at the time, John Goodfriend would come over with his cigar or without his cigar. Sometimes he didn't smoke one, and sit next to me. And I was, I was 27, young kid, a kid on the desk, but had developed a reputation, fine. And he would sit with me as I traded, watching the flow, seeing what customers were doing what, seeing how our risk was shifting, and giving comments, and just sitting with me, just hanging out. And he would do it multiple times over the years, over the 3 weeks or so. And I look back at that and think about how he was acting and how important it was for him to see the firm do a great job on this trade, see actually how it was happening at a nuts and bolts level, and live in the moment. While it's certain he already knew that his fate had been sealed by what was going to unfold in the next couple of weeks. And so, that's the story. It's fascinating glimpse at a guy who, wasn't perfect, and definitely took responsibility for what happened on his trading desk in the Treasury auction scandal, but at the same time, cared deeply about making sure that Time Warner got a good execution and that the firm survived the risk it was taking.
That's very fascinating. And just seeing that accountability from John Goodfriend is pretty awesome. Moving on to markets today. One thing that you see across Twitter and just across the consensus in general is most people have resorted to taking the view of either being a bear, or they've resorted to taking the view of that we're just going to see volatility and chop over the next few months. Meanwhile, you're sort of the lone bull. So what makes you bullish over say the next few months, pretty much the short term? And now, how are you thinking through equity markets in this environment?
Well, I'd like to stop you there a little bit and say that if you go on to dampspring.com and hit the Damp Spring Report tab and read that report, you'll see that I place a high significance on 2 events that are happening in the first week of May. Obviously, one that everyone is, aware of is the Fed meeting, where it's almost certain that either immediately or by June, they'll begin quantitative tightening. And we'll see the details of the quantitative tightening, both in terms of how runoff will be handled and in what size and what speed. And I expect it to be very fast, immediately at the highest pace ever done before, and then scaling up from there to twice the highest pace done before in the months that follow. And that on its face is a significant headwind for not just equities, but all assets, from every portfolio asset, from gold to commodities to equities to bonds. And so I'm very interested in that outcome. But the day prior, and again, this is the key, the day prior, the transmission mechanism of quantitative tightening isn't the fact that the Fed isn't buying. It's the fact that the Treasury continues, obviously, to fund its deficit, needs to sell. And what they sell is the transmission mechanism. So if they sell, for instance, if they were to issue only long bonds, of course they won't, but if they were to issue only long bonds, that would be to fund the budget, and the Fed is not buying anymore. That would have the amount the Fed isn't buying would have to be absorbed by the market. And they would need a significant concession in the form of risk premium expansion to take on the risk of levering up their portfolio with these more bonds. And 30 years do the most damage to that thing because they're the riskiest. On the other hand, if they were to issue only bills, the bills market is extremely deep and very low risk, and would have very limited effect on overall market-wide risk premiums. So that balance is very important. And on May 2nd, the quarterly refunding announcement will be made, and we'll see what Janet plans to do with her lever of what type of issuance she wants to make across the maturity spectrum of potential sales in the coming quarter. And the total amount of debt she wants to sell, because, you know, taxes are going up because nominal inflation is high and nominal incomes are high. And so tax receipts should be going up as the economy is growing at both a positive GDP level and a nominal basis. So we'll see actually how much debt she even needs to sell. Anyway, that's an important lever. And it also relates to the fact that the RRP, which is the Fed's facility to stabilize the money market, has 1.8 trillion or so of bills seeking assets that really would, you know, savings, human being savings and corporate savings that really wants bills but doesn't find the yield attractive enough because there isn't an adequate supply. And so it's possible that Janet could, and I'm not sure that she will, because there are a lot of interests that need to be figured out, which my report attempts to address but doesn't make predictions. I want to see what happens on May 2nd, and that could significantly change my outlook. I could be extremely bullish assets if she decides to sterilize QT, or extremely bearish assets if she decides to issue 30 years. And so that's the pivot point. Coming back to today, you know, we've had since the minutes in January 4th, global portfolios have suffered a lot. There's been significant drawdown. The 60-40 portfolio has behaved poorly. The risk parity style portfolios have behaved less poorly because they have an allocation of gold and commodities. But by and large, portfolios have behaved poorly, and that's because of QT and rate hike impacts on risk premiums. And so mid-February, right before the war was announced, I looked at all of the prior tightening cycles back to 94, and saw that in those tightening cycles, this same thing happened, where all assets behaved badly. Correlations for all assets flipped, you know, rates and equity correlations flipped from negative to positive, and all assets went down. But also at the same time, they bounced. And so I think we're in that phase. But I want to step back and say, the rally in equity markets has risk premiums that had expanded ahead of QT, going to an extreme, while at the same time has also been fueled, and this is what explains the sell-off, the extra sell-off in bonds. Bonds sold off because of risk premium expansion as well. But lately, and this has been a sort of March event, what I think has happened is that growth expectations through February were, and then the war started, were dismal. Just as it's an inaccurate measure, but just as a point of reference, GDP now predicted a 0 GDP in late February for Q1. It's now reading 1.5. They're both not right. Who knows what the actual number will be? We'll see. But at the same time, all of the major houses, at both on the sell side and what I read from the buy side, have been suggesting we're suggesting a recessionary risk accelerating. And that makes logical sense, with the Fed tightening and the war and supply constraints impacting demand and just regular old inflation impacting demand, that people got very, very bearish on the GDP. And so I saw that turn and levered up my equity exposures and sold bonds. And I think what you've seen is that that's what's played out. A combination of risk premium that had been far too expanded ahead of QT and growth, which had been far too discounted ahead of whatever, have reversed. And that's caused equities to go up sharply and bonds to sell off somewhat. And because literally those are they do the opposite thing. Both of those influences, the equity is a double positive, whereas the risk premium contracting and growth expanding is a net 0, but growth expanded faster, and so bonds sold off. And so that's where we're at now, and I expect to be fairly choppy in the next few weeks. The good news is the supply of bonds will not restart until April 11th, because we're in a period when issuance by the government isn't being done. The bad news is the minutes are coming out, and so that's tomorrow, and people are undoubtedly going to act surprised at how aggressive QT is going to be. I don't think that's right. I think people really have gotten comfortable that QT is coming. What its impact will be will depend on May 2nd, but it's coming, and I think people are beginning to understand that. But the minutes may be a point of volatility. The CPI later next week will be a point of volatility. And so I think those are trading options. The CPI is going to be unbelievably hot and like blazing hot. And so I think everyone expects that. So it's possible that might be over discounted at this stage, but we'll see. So that's my playbook. My playbook right now, as I posted, is I'm long equities. I'm scaling out of them, frankly. And I'm long bonds because I think this growth impact may actually slow. I just took off my short yen position for a number of reasons. It's been immensely profitable, so it's time to take some risk off. What else do I have? Oh, and I'm also long dated oil, which I think is a fascinating trade, particularly in the face of my original trade was to be short 3-month oil and long 3-year oil, which was backward dated by 30 points, meaning say 110 versus, well, I guess it's been even higher than that, sorry. Though I think the 3-month never got above 110. Look, call it 110 versus 70 at the lows, which was a 40-point backwardation. I put it on 30, so it's getting squeezed a little bit. But that implies that oil will actually be a deflationary pressure over the course of the next 3 years, which I don't think is consensus. I think people think oil's going up, not going down. But spot oil already reflects, is trading it now at about 100, and long dated oil is trading around 80. And so it's still expected to decline over the next 3 years. And so I've unwound the short side, and now I'm just making long dated oil as a proxy for inflation risk.
Gotcha. And so, going back to QE and QT, so, one, what do most people actually get wrong about the transmission mechanisms of QE and QT? And two, the way you analyze it from a risk premium standpoint is just very interesting. So, so I guess that sorry.
Sorry, you said what do people get wrong?
Yeah. So, what do most people actually get wrong about the transmission mechanisms of QE and QT?
I'm not sure. I'm not sure anybody gets it wrong. I think it's hard to understand, but it's a fairly mechanical issue. And so I'll just say what I think is that when the Fed buys bonds through the QE process, they
reserved for.
Well, there's a plumbing issue which I think is entirely over-focused on. I'm going to focus on not the reserve build and contraction. I think that's because reserves are no longer a constraint for banks. You don't have to have a certain amount of reserves to lend. I think that's an overstated point of view, but I don't want to make this about plumbing. I want to focus on what it does to the economy and what it does to asset prices. And so when the Fed decides to buy bonds, they buy bonds, and the seller now has a deposit. And the seller is anybody in the real economy. And that seller has a deposit, and they used to have risk, and now they have cash deposit. And so they have to decide what they want to do with that deposit. And most people during QE say, I'd like to buy that bond back because that's really what I want. So I'm going to look at something that's similar to that. Because the bond has now, to incent me to sell, has now gone up, maybe I'll look to corporates. Similar maturity, maybe high grade corporate.
They move along the risk curve.
And they'll take a similar asset, but not exactly slightly higher out on the risk curve. And that process then results in somebody else being the seller of that corporate bond, and now they have cash. And so let's talk about one of the transmission mechanisms that exists in the US that doesn't really exist in any other country, is that Apple can sell that corporate bond to the buyer of corporate bonds who sold the treasury bond to the Fed. And then they can buy Apple stock through a share repurchase. Now, somebody who had Apple stock doesn't have Apple stock and has cash. What do they do with it? They buy some more risky stock. And that person who sold the risky stock buys a more risky stock. And then ultimately somebody says, my wealth has increased enough because of this process of inflating assets that I'm going to consume. And so they take their deposit and buy a service or good. Now that service or good ends up with a deposit for the seller of the service or good. And that whole thing starts again, where there's now deposits offset by the reserves that the Fed created, if we're going to get back into the plumbing, that may or may not need to be invested. But the process has caused all assets to inflate. And the wealth effect is the transmission mechanism to the real economy, because the wealth effect, that flow, that inflation of financial assets, creates the demand for the good, which is mildly inflationary.
Got it. Yeah.
Now, the problem is it's mildly inflationary. And if you look at QE throughout the history of QE, which it hasn't been that long, you haven't seen runaway inflation by any stretch of the imagination during periods of QE prior to this one. The difference between this one and the last one is that, and I think the Um,
Like a difference.
I think that the QT, the reason for inflation hasn't been that QE had been happening, but that the federal government issued notes, which the Fed did buy, so there was a relation. Not directly, but that's again plumbing issue. The Fed did buy, but the inflationary thrust was the placing of savings into some, human beings and corporates bank accounts that they could then spend on real goods. And so it is a very, deficit spending, if accompanied with quantitative easing, is highly inflationary. Deficit spending, when not done with QE, is inflationary for real goods, but deflationary for assets, because the bonds that finance this spending have to be sold. So hold on one second. So anyway, let me just type this in. That's what QE is, and why QE with fiscal is inflationary. And regardless of that QE, the important point is that QE is on its own a weak generator of inflation, because it affects the consumption of the people that own assets, whereas fiscal affects the consumption of people who receive wealth transfers from the federal government. And those people tend to spend that money, whereas the wealth effect doesn't necessarily. So anyway, that's the way I think inflation works, and why we have an inflationary environment now, besides the supply chain issues and the post-COVID demand spike. But QT is also going to work through that same channel. In this case, it will reduce consumption because of the wealth effect being anti-wealth effect, but only mildly from those who have assets. It won't affect the consumption of people who don't have assets. And so it's not the Fed's preferred means of fighting inflation. Their preferred means, they've stated time and time again in the last 6 months, in the last 4 months, is rate hikes. And those are very effective and have proven to be very effective fighting inflation. Now, I don't know whether what's priced in is going to be enough. We'll see. There could be another phase of significant tightening and some sort of whoops moment, or it could actually work, and we'll see. But the quantitative tightening bit will have an effect on financial assets, but will have a weak effect on the real economy.
Gotcha. And so, to that end, do you think that, generally speaking, interest rate markets are being overly hawkish about what's going to happen with regards to rate hikes? Because if I remember correctly, you are long the December 2023 Eurodollar futures.
Yeah. I just put that on just recently, like last week, I think. And I'm underwater by 10 basis points or so, probably more today, as the bond market seems to be taking a puke. Not bad.
Is that a view on recession?
I'm not sure. It seems like the terminal rate, it's priced such that the terminal rate happens is close to 3%. Here's my outlook. I think that inflation is complex, and my next damp spring report is actually going to talk about this very topic. There are a lot of ways the economy could evolve. There are some my old boss at Brevin Howard is focused on persistent supply chain disruption. And I see that. It doesn't resonate to me as much. Supply chains tend to evolve. But Greg Jensen, my prior boss at Bridgewater, has a more nuanced view, I think, that I can get behind. And that is that supply chains will resolve. Demand remains and the economy remains strong, and so his outlook is that there is not going to be a recession and there is going to be higher inflation for longer. And it's based on the one pivot point, which I'm not sure I'm there yet, but it makes logical sense to me, is that it'll be demand driven. The supply chains will be what they will be and resolve over time. But it'll be demand driven by a political decision to protect each country. Europe in particular is probably the most vulnerable to this idea. Britain a little bit less so just because of the relative size, but even the US, that will fight the war that we just experienced. And the war that we just experienced is a war in which supply chains, whether it's COVID related or literal war, that were thought to be reliable are no longer thought to be reliable. And that will generate government spending, deficit spending, that will replace the spending that was done in COVID, but still be sizable. And instead of being wealth creating for individuals, which COVID was, in that people literally wealth was literally transferred from the federal government into individual people's accounts, it will be infrastructure spending. And what I mean by that is, and again, I credit Greg for this point. I think it's a very interesting point, that the political winds will shift toward domestic energy production, whatever that means, combination of renewables, oil, gas, coal, for each nuclear, for each country that's affected based on their own particular needs. So that, countries, sovereigns, are not as vulnerable to supply chain disruptions from foreign nations. And in other supply chain rebuilds, the best example right now is the chip crisis resulted in hundreds of billions of domestic spending to build foundries in the United States. That sort of thing is both inefficient from an economic standpoint. It's part of the deglobalization, which is a negative and inefficient use of capital, but a reality associated with sovereigns and their desire to protect their citizenry, but is inflationary, both from a money gets spent that gets printed out of the deficit and in the real economy on these types of projects. And the output of those projects, the commodities, the chips, are going to be more expensive because they're being made in countries that don't have a comparative advantage. And so that's an interesting thing. And I think you then have to look at countries that are capable of unilaterally making these forms of spending versus countries that have political gridlock, though this particular issue is fairly bipartisan. The United States has a political gridlock, which isn't likely to change, could get worse by election day. But it seems that even in the US, there's a fairly bipartisan wind that could shift toward energy production, though there'll be definitely debates about which energy to produce that may create gridlock, and infrastructure, domestic production spending. And if those happen, this sort of strong economy and above trend inflation could be a global phenomena. And then if you have that global phenomena, bonds are going to be a very bad place to be. But, that's not that's one of many outlooks.
And one of many possibilities. Moving on, I wanted to get some thoughts on the way you trade options. So, one thing that you do a lot is express a lot of your views just through options. And so when it comes to picking the options that, you're using in a trade, how do you go about, picking the right options? And, how do you go about structuring these trades? Because some of them, tend to be spread trades. Some of them tend to be naked. So how do you think through those mechanics, and how do you think through, which options to pick and which trade structure to use?
Yeah, so I'm just going to give you some framework ideas and also some cautions about reading too much into the options I trade that should be related to this framework. I guess firstly, the primary reason why I use options, besides having traded options all my life as a derivatives trader, is purely for risk management purposes. That is the primary reason why I use options. My framework is that I refuse to experience a tail event, a drawdown above a certain threshold, and that for this portfolio, it happens to be a 10% instantaneous drawdown of my inventory at any point in time, no matter what the circumstance. And the only way to do that, stops don't work in those circumstances, because stops can get run and, you miss them and you sell them much worse than you could have if you had gotten your stop off, or worse, you could have market closures. And so there's tremendous tail risk in stop versions of risk management. And so I don't use those. I've just learned enough to know that for me to be able to sleep and be comfortable with my upside risk, I really have to protect my downside. So I do that. And how do you do that? You trade long premium through either long calls, long puts, or long spreads of calls and puts, 1-by-1 spreads. Any ratio spread could potentially expose you to tail risk. So just simply that. And at the same time, I don't want to just bleed theta for my entire life. And so, because I think honestly, theta is giving away risk premium that I would like to collect. So I try to balance theta. And I do that by expressing bullish trades through put spread sales. Again, they have limited known upfront worst case. Or sell rips through call spread sales, again, limited risk. Occasionally, I'll take a outright option position when vols are, which has to be long, when vols are, because I want to minimize risk, drawdown. When vols seem inexpensive to me, but I just don't want to layer in too much onto that, because the primary reason why I do this is risk management. The primary alpha I feel that I have, if I have any alpha, which you never know, is through delta. And so my primary reason the trade I'd like to express, if I could avoid all tail risk, which I can't, is to be just long futures or short futures. That would be my ideal expression for pure alpha purposes. I just want the delta. And so the intersection of wanting to express my view as a delta, but also having known worst case outcomes and being theta neutral, ideally, though that's hard to do, generates my portfolio. The strikes, gosh, That doesn't, the expiration, so the expirations matter. Let me come back to that one, because I think that's a reasonable point. If I have any alpha, which who knows if I do know that my expectations for realizing that alpha are less than 3 months. I don't believe I can. I think it's very hard to trade markets with prediction of particularly and generate a high ratio if your horizon is much longer than 3 months. And so whatever it is, my systems, my way of trading generates a 3-month sort of outlook. And so I generally use 3-month options. However, that's not a rule. That's just what I want to do when I look at options. I don't love trading options that have higher vols because of contangoed vol markets. So occasionally I'll go shorter. And lately, we've been in an environment in which I think the fundamentals are shifting in such a significant way from a Fed being essentially a damper, which damp spring refers to this, a damper for the economy getting worse, to being a damper for the economy getting stronger, and that is literally transitioning. And the macroeconomic news and people's positioning and their loss taking are all, I use this damp spring model for volatility, and they're all reading like this volatility is, at least until recently, has been likely to persist. And as you know, I have this big pivot point on May 2nd. And what we've seen essentially is months worth of returns. Again, my horizon is sort of 3 months. We've been seeing 1 month returns on asset prices in 2 days. And so that's bringing me, recognizing that if I have alpha, it's probably going to be realized sooner, bringing my options exposure a little shorter than it had been. I don't expect that to persist past May. I think I'll be back in the 3-month sector after that. But again, it's not, I wish I had some secret about, which options are the cheapest. Maybe others do. I've done so much work on skew and the vol surface of every asset and correlation coefficients and dispersion trading and all of the highly quantitative technical ways of looking at the vol market. I don't think I have any alpha versus anybody else on that. So I pick the things that have interesting delta exposure. Some, if I'm buying options, some reasonable leverage. If I'm selling options, some reasonable expectation that the vols are pumped. But there's no magic. I wish there was, there just isn't. It's mostly that high level framework of wanting a delta, wanting it to be 3 months, and wanting it to be fit in my risk framework.
Okay, so do you think that in order to sort of successfully trade options, you would need to be well versed in quantitative techniques, or do you think that even without, because I believe you said that you had a med background, so I'm guessing you have some level of math background as well, just based off of that. So
yeah, no, I mean, the math of options is not particularly complicated, so that's trivial for. There are lots of very, very smart people that have way more degrees than I do, that know way more about the math than I do. But to understand options, you don't need that level of firepower to have a basic understanding, enough to trade. I think the biggest mistake that people make in trading options is leverage, which has nothing to do with all these Greeks. It just has bet sizing issues. So for instance, if you have a $100 portfolio and you have $80 worth of out of the money YOLOs, that's a fucked up portfolio. You're gonna lose all your money playing that way, or you might make it, but you might as well go and pick up a lottery ticket. It's not quite as bad as the probability of a lottery ticket or the fair value of a lottery ticket, but that's bad risk management. But if you're, I was talking to one of my clients today about about hedging. They were getting nervous on the equity market and they wondered how they should hedge. And I said, well, everyone would buy puts. That would be the way to hedge, and the price reflects it. And their high transaction costs. What if you don't like the market? Go to cash on some of it. It's simple, it's cost effective. There's a tax relation, which this was a non-taxable account, but put some in cash. That's the simple trade. And then she said, well, what could I do a stock replacement trade? And that is sell your stock and buy a call option. I said, sure. But if you do a stock replacement trade, make sure you're doing it on a share for share basis, not a cash for cash basis. Because if you're just buying premium and you're levering up, that's the exact opposite of what you want to do. So I guess the big issue with options trading is that if you stay within your skis from a risk standpoint, and have not a mathematical understanding of options, though not to say that's a bad thing, it's great, but if you understand that during periods of extreme stress, options are going to trade rich relative to what they did prior to the stress event occurring, and the transaction costs, the bid offer spreads, are going to be enormous. And most importantly, you're jumping into shark infested waters where the best market makers in the world are there to eat you. And so I strongly, strongly urge people not to participate in the options market during a stress event. That's earnings, right ahead of earnings. That seems like an extremely lucrative event for market makers. And not for clients. And then certainly in times of overall market. So there are lots of ways to use options. There's to use them as a risk management tool. There's to use them as a hedge. There's passive uses of those as hedges. All I think are valid strategies, but jumping in when you need to hedge because you're facing margin calls, you're over levered, whatever, and things are going bad, is terrible ex ante planning. Just plan for something else.
Yeah. Andy, to wrap up the podcast, there's a question on Twitter that, you were excited about as well. And so, what is the best question you have ever been asked?
Well, I said this question is the best question I've ever been asked, which is sort of meta. So I don't have a great answer to that. Most questions are ways to open me up to talk, and yeah, I don't have that. That's about all I have to say on that question.
Gotcha. Andy, any closing thoughts before we wrap up?
Yeah, I mean, I think you have to really pay attention to the early weeks in May. I think there's a major pivot. It's all I'm thinking about. I've done a tremendous amount of work on it. I strongly encourage you to visit me at dampspring.com and read the report, and ask me questions. And I really enjoy the opportunity to give out my thoughts for what they are.
Andy, thank you so much for being on the podcast. It was absolutely awesome having you.
Thank you, Sri.